Okay, balance, imbalance. Balance and imbalance are terms that we use all the time. You hear me talk about it in the reports constantly. I'm sure you hear Troy talk about it in the room. Balance and horizontal development, they're synonymous. Now these are, and this is part of something we're going to expound on in the next session, but these are part of the two phases. There are only two phases of market development, horizontal and vertical. Balance is horizontal development, imbalance is vertical development. Balance and horizontal development are synonymous. It is a specific market condition, and there is a specific market behavior when a market is balancing. Price activity is confined in a range in balance, in horizontal development. Invariably, you will have balance will transition into the next phase of development, which is imbalance or vertical development. This is another, these are auction market / market profile terms for trend and consolidation. This is a consolidation, this is a trend. Markets consolidate most of the time. It's the function of the market to consolidate because it's facilitating trade, which we're going to talk about in just a minute. But there are two phases of market development, balance and imbalance. Balance is defining value. It's where value is known, which is a critical key concept, and we'll get there in just a minute. Okay, trade facilitation. The primary purpose of an auction market is trade facilitation. This is maybe the single most important concept to understand when viewing markets in any time frame through this particular lens, using this methodology, because you're asking yourself, is trade being facilitated or not? Trade is being facilitated when it's easy to buy in an area, when it is as easy to buy in an area as it is to sell in that same area, so that you have time to do it and you can do it in size. That's trade facilitation. I can buy or sell 10,000, I can sell 10,000 contracts as easy as I can buy 10,000 contracts, and it doesn't take me any more time to sell 10,000 as it does to buy 10,000. That's trade is being facilitated. Now, trade is not being facilitated in rapidly trending markets. It is an inefficient market condition, and the market is not doing what it's designed to do when it's trending rapidly. The normal and desired state of the market is trade facilitation. Markets are efficient when they are facilitating trade. That's what they are designed to do. Now, there are trends and then there are trends. Let me show you an example. You can have a strong trend with trade facilitation, and you can have trends where you just have absolute, total, one-sided inefficiency. The total, absolute, one-sided inefficiency state never lasts for long in all time frames. It will last, there are periods of time where it's just overwhelming in all time frames for a relatively short period of time. And we have a wonderful example of that, of both of those situations now, and our friend, the ES. Okay, on December 31st, the stock indices took off in all degrees of time and traded dramatically and rapidly higher. This is the poster child for an inefficient market. Trade was not being facilitated. If you wanted to buy 10,000 contracts or sell 10,000 contracts, you were chasing this market. Trade was not being facilitated. Your fill was all over the place. It wasn't like here, where you could buy or sell 10,000 easily. In here, you were just getting killed. Now, Troy's point is very key. You can have, these phases of development are all ongoing in all degrees of time all the time. So most of the time, you'll have balance in an intraday time frame where on an intermediate term basis, it's clearly trending. And that's what we're getting into. When this occurs, you know the market is not going to continue at this rate of change. And you understand why. There's no trade facilitation. The price will become increasingly unfair to the buyer at this rate of change. It's just not going to happen. And you can see what has happened since January. We have a relentless uptrend, but it is rotational. Trade is being facilitated. You know, you are having rotation, and there's the potential, like I said, potential that maybe you're going to begin, spending more time in rotation, which would be typical. Now, if you go back and look at, let's do that. Okay, daily. Now, one thing I want to point out, this is a good time to do it. You don't have to guess. And I'm going to do this because I'm going to save this chart. You don't have to guess when this market is topping out. It's going to tell you when it is. And until you have some signal that on an intermediate term basis that something could be developing, it's fine to play the rotations and to sell this intraday. But it's not fine to think that barring, until some signal occurs, that you're going to get any more of that than some significant piece of the day's range. So if you're selling this market right now, what's average true range right now? Let's look and see. Okay, average true range right now is about 13 handles. So if I sell this market and I get 7 or 8 handles, that's great. I've captured, 60% of the range of the day, counter trend. I got to be happy with that. So that's another example of using market condition to dictate your trade strategy. I'm not trading this market right now under any illusion that I'm going to be the guy that sells the top tick as it drops 40 handles. Now, we are up from the December low in this market. This 9.28%, 9.3%. All right. You think that's a lot? You think that's overbought? The market has to go down? Well, we had a similar move in 2012. This looks a lot like this. And this is 9.3% right here, roughly. So this is 9.3%. This is 9.3%. There's nothing that suggests, nothing so far, that this market won't go a whole lot higher. Now, and this trend was relentless, but I want you to notice that if you understand what's going on, there will be opportunities intraday to sell and, and take realistic intraday trades. But you have to understand what you're dealing with, and you have to understand what your expectation should be based on probabilities. So, most of the advance from here all the way up to here was quite two-sided with a few periods of conviction in there thrown in. And that's something else. You don't want to find yourself. There's still likely to be, in my mind, there's likely to be some more wide range days up before this thing ends. But it should be, the expectation is that following, say, a wide range day up like you had here, the market becomes two-sided for a few days, and you've got some rotation that's tradable from an intraday perspective. And this is understanding market condition. You use this knowledge to dictate how you trade any market, any given market. This could be lean hogs. It could be the Swiss franc or whatever. The analysis would be the same. This just happens to be the S&P. But don't think for a minute that there's some sort of standard for overbought that this market has reached and it can't go higher, because it sure can. So this gets back to trade facilitation. We're in an uptrend in the S&P, but trade is being facilitated. It's become more rotational on a day-to-day and intraday basis, because the normal state of the market is trade facilitation. And this will create a lot of people at this point that are chasing this market. They'll lose money too, because they're going to be buying every single high and then have it come back in their face. And that'll happen 2 or 3 days in a row. And then finally, they'll sell it and it'll go up and you'll have a wide range day to the upside. So just understand you're at an advantage in understanding market condition and an if-then type of scenario. You don't want to be caught short in this market very far above the previous day's high, because if you do, you're going to run into a situation like this or like this where you're getting run over. So if you're fading a range in this market, just understand you don't want to give it much room above the previous day's high, or you're playing with fire. And I still think you're going to see some more wide range up days before this thing rolls over, which it invariably will.